Hi, and welcome back to our channel, Pay Down Debt Solutions. I'm Jen, and today I'm going to break down for you guys the Velocity Banking basics. So we get a lot of comments that that you kind of understand what's going on with Velocity Banking, but some of the little basic parts of it, like calculating interest and how you find your available income, things like that, have been a little bit confusing. So I'm going to go through today and break it down for you so that it makes more sense, okay? So we're going to go over Velocity Banking basics, the pay down strategy. We're going to go over the concept itself of Velocity Banking. And then I'm going to work a student scenario of a single parent with you where they are using just credit cards. They don't have any other options. They don't have a line of credit. They don't have any other options for them at this point in time. So we're going to work with what we have, and it's tight for them because they have zero cash flow. Okay, so zero cash flow, and they want to get out of debt. And they being mother, and of course she has a daughter that is living with her. So let's go over those basics for you. And what I'll do too is after I work the scenario, I'm going to show you the savings that they have over traditional banking and how Velocity Banking makes all the difference in the world when you learn it and learn how to do it right. And I am winded today, you guys. I don't know if you've ever done this, but Dan and I do 5-day fasts once a year. And we do it for health benefits for, I don't know if you guys have heard of autophagy, but that's, clearing up the dead cancer cells and things that are in your body and the folded proteins and things that, that happen inside your cells that lead to what they think is, Alzheimer's and other autoimmune diseases. So day 4, so I'm pretty tired. So, if I have a little bit less enthusiasm, I apologize for that. But anyway, let's get right into it. So, Velocity Banking basics. The paydown strategy is the basics of Velocity Banking, and it is the best way we found to organize Velocity Banking for you so that it makes sense. It gives you step 1, step 2, and step 3 to make it super simple, okay? So the Velocity Banking basics and the paydown strategy, number 1 is to organize all of your debts and all of your income, which we have a sheet that if you guys want to email us, we can email that out to you. But but just organize it on a piece of paper. You don't really have to have a spreadsheet, a special spreadsheet, which we will send you. But if you want to just organize all of your bills on any spreadsheet or a piece of paper, a notebook, it doesn't matter. So you're going to organize every bill. So you're going to list out every bill and every debt that you have, everything you can think of, down to the itty bitty tiny subscriptions that you have, and even your eating out and entertainment. All of that needs to go into the spreadsheet. Okay, so that miscellaneous stuff. And then you're also going to write down all of the income that comes into your household. All right, so it's going to be organizing those debts and that income. And then 2, it's going to be identifying your debt destroyer. Okay, so what do I mean by that? So a debt destroyer, when working with Velocity Banking and working the paydown strategy, is going to be a line of credit. And in today's example, we are using credit cards, 2 of them to be exact, okay? So you can use lines of credit to work down a strategy and give yourself back money through cash flow. And that we will go into a little bit later. But you're going to be identifying that line of credit tool that you are using. So again, it could be a credit card, it could be a home equity line, it could be a personal line of credit, it could be a business line of credit, all right? 3, you are then going to implement your strategy. So what do I mean by implement? I mean work it down, right? Money goes in, money comes out, and you're going to be working it into that line of credit. So that is implementing and working down your strategy. Now, Velocity Banking truly is simple, you guys. I know that a lot of you out there, sometimes your head goes, right? You have that head blown experience when looking at Velocity Banking. But keep watching videos because you will find that it will be broken down for you and you will start to really understand it. And today I hope I make some of that a little bit easier, and I hope I provide clarity today, okay? So it really is very simple, okay? So the concept, and the simple concept, right? The concept is using simple interest debt tools, okay? The simple interest debt tools to work down debt through income in and expenses out. That is how we win, is the income in and expenses out, okay? And simple interest debt tools, and I've talked about this just a second ago, right? Those simple interest debt tools you can use are credit cards, home equity lines of credit, such as a first lien and a second lien, personal lines of credit, or a business line of credit. So some of you out there are business owners, just like Dan and I are, and you have those business lines of credit, right? So you can use the business lines of credit as well. Now, what makes this work so well is simple interest, okay? And simple interest is calculated on an average daily balance. Now, we all know, and if you don't know, you're going to know now, that loans and mortgages are calculated on an amortized basis. So they're amortizing that interest. So that interest that you're being charged for your mortgage or your typical loan is going to be all front end loaded. That means that the interest you pay when you start that loan is going to be more than you will pay at the end of that loan. Not only is it going to be more, but the balance, okay, what you pay towards your balance is going to be less in the beginning and more as you get towards and deeper into that loan, okay? So that is the amortized schedule. And velocity banking works through simple interest. And I'm going to show you and display for you how exactly that works. All right, so when you're faced with debt, you feel trapped. Boy, do Dan and I understand that, right? So we are business owners now, and we were both in the corporate world, right? So Dan worked for a car company as an engineer, and I worked in the banking industry. I was a banker and also a branch manager. So I'm coming to you with the knowledge of these tools and from understanding corporate America and understanding paychecks. So not only do we understand the paycheck side, we understand the self-employment side and how you're basically, taking money out of your business to live at times, right? So business owners know that that's what we do. So when you feel like that, right? So when you're in a situation where you have all of these payments, okay, you're making all of these payments because the traditional banking structure wants us to make payments like that because they get interest, right? They're a business. These banks are businesses. And that is how they make money. They have shareholders, right? And they have to report to them. So they need to make money, and that's what they're doing, okay? Now, when you're faced with debt and you feel trapped, you are making multiple payments monthly, and that is what's keeping you broke. And again, that is, you're making these payments because somebody told you could. Somebody looked over your finances and said, hey, you can afford this payment. So go ahead, take on another payment. And you do, okay? And that's what happened over here with this student scenario where she was taking on some payments. And it turns out she really can't at the end of the day afford them because she's barely breaking even. And she has higher credit card debt because the months where she wasn't breaking even, she was going negative. Of course, she's putting it on a credit card. And that's what we do, right? That's simple. That's what we do because we don't have any other options if we don't have any other income to use. And that's what she did. So traditional banking sets us up to make payments and they encourage it. Well, of course they do. Of course they do because, right, again, it goes down to their bottom line. And how do they make money? They make money through your deposits and they make money through the interest you're paying them, right? That's how the banks are making money, and that's how they're lending more and more money to other people. So they allow us to afford, right? To afford the things we really can't afford if we stay in their payment cycle. Now, some of these things we can't afford as long as we don't use their payment cycle and we use velocity banking, which you're about to learn. So velocity banking gets you out of the traditional banking payment cycle, okay? So we are about to break you free from traditional banking and show you a different way where you are putting all of your income in to a line of credit and working everything down and out through expenses out. So that line of credit then becomes your bank and your checking account, okay? So that's what we're going to do. So let's go and look at the student scenario that I have for you guys today. This is a single parent. The income that she has is $53.90, so she has a respectable income. Her expenses are also $53.90 though, and that is where the trouble comes in, right? She's at even, she doesn't have cash flow, and at times she becomes negative when she has extra things that she has to payment, like things that crop up, right? That's when she becomes negative. So she has non-chargeable expenses of $2,310. So what exactly do I mean when I say non-chargeable expenses? And I'm making a distinction between chargeables and non-chargeables because we are using a split card strategy to help her get out of debt. And when we use credit cards to get ourselves out of debt, we have certain things that we cannot put on credit cards, such as rent payment, car payments, any loan payment, and even credit cards. You can't pay that with a credit card, but there are still ways we can get you out of debt. No worries here, right? So we have non-chargeable expenses of $2,310. So what is that? That is her rent, which is at $1,280. It's her car, which the car balance is $21,543 at a 6.4%. She's paying $420 a month for a car payment. She's got a Discover card here at $8,000. It's at 27%, and she pays on that $260 a month. She also has a Capital One payment that is at $12,750. And it's at 19% though. So there she at least has a decent rate for her credit cards at 19%. But this is at $350 a month, okay? Now, she has no ability at this point in time to get any other line of credit. She can't get a personal line of credit, and she can't get an equity line of some sort. She also can't get a 0% credit card right now. So we have to be able to work her strategy a different way. And so what we're going to offer her is a split card strategy where she splits out the payments on these credit cards and gives herself some income back through cash flow. So let me explain. Now, if we continue to go further here and we talk about chargeable expenses, okay, so non-chargeable, obviously, right? Rent card, Discover card, which is a credit card, and a Capital One, which is a credit card. So these cannot be charged on a credit card, right? We can't do that. So what we also have to do is hold our income out into our checking account to pay for these, because these we do have to pay through checking, all right? We have what are called chargeable expenses. Now, these are expenses that you can pay through a credit card, and that is what she's now separating things out. So she has her chargeable expenses that she's going to put on her credit cards, and she has her non-chargeable expenses, okay, which are these here that have to be held out in both in income, okay? So when we take a look at all of our expenses, the chargeable expenses are $3,080, okay? And also, in this case, her income that is available is also $3,080, okay? Because remember, you have to hold this out of income, right? You have to hold that out of your income. So now what we're going to do is I'm going to break this down for you. So let me erase the board, and let's talk about our split here and how we're coming up with our available balance of $1,890 and $1,800, all right? So let's get rid of this for a second. All right, so now we know that she makes $53.90, okay? She makes $53.90, but because we're running a split credit card strategy. Now, we're running this strategy this way because when we put income into a credit card, we get our payment back to us, okay? So what do I mean by that? This is what I mean. When you put on this card, okay, so here's our Discover, is that Discover? Yeah, here's our Discover card, and here's our Capital One card. And the payment on the Capital One card is $350 a month. The payment on the Discover card is $260 a month. Okay, so if I take the available income as it is now, okay, the 3080, right? So we have 3080, okay? So 3080 is the available income, right? And we're going to then divide that by 2. And that is going to equal the 1540, okay? So she would split between two cards, 1540, okay? But that's not what I have on the board, is it? I have 1890 and I have 1800. So how am I getting that? Well, this is how I'm getting that. So if we have 1540, so here's 1540 and here is 1540, okay? I need to add back, so if this is Discover and this one here is Capital One, okay? Discover, Capital One. Now, my Discover payment is $260, isn't it? So I get to add back $260 into my available balance, okay, my available income, I should say. So her available income, she's adding back $260, so that gives us $1,890 then in income that we are putting on that particular card. So this Discover card, we're going to put $1,890 on it. Now, why does that come back to us? Well, because as credit cards are run and all lines of credit that deal with simple interest, as you put your income in and well satisfy that payment, you're not just satisfying it, you're over satisfying it, right? So you've satisfied that payment. So that payment amount is no longer due. What is due is the interest though. And that is for both of these cards, right? So I'm going to go over that in the next step. But here we have the 260, right, that we've added back in. So 1890 for this card. And now the next card there, the Capital One card, is 1540 plus 350, okay? Did I do that backward? No, I did that right. Okay, so it's, oops, 350. Okay. Oh, I did this backwards, guys. I'm sorry. So this is 1890, and this is 18, whoops. Let me find an eraser. Sorry, totally backwards. Okay, so this is our 1890. Okay, and this is our 1800. Sorry for the confusion. Obviously, I didn't do the math in my head or elsewhere, right? So we've got 1540 plus 260 equals the 1800, okay? And we've got 1540 plus the 350 equals the 1890, which is your Capital One card. So that is where this income is coming from, okay? Now, it just so happens that the 1540, okay, because of the fact that she's at a 0%, at a zero cash flow, it just so happens that when you look at the chargeable expenses, they're 3080, right? So if we take our 3080, right, and we divide by 2, that also equals the 1540. So those are the chargeable expenses. Now, when you're working with credit cards, okay, your chargeable expenses are still your chargeable expenses, okay? And your non-chargeable expenses still remain your non-chargeable expenses. So what we get back to us then is the income, okay? So our income then comes back. So this 260 and 350 comes back into our income because we no longer have to hold it out, right? It's actually freed up that income. So now, instead of our cash flow being 0, it's 260 plus 350, right? So, right, if we take that, the 260 plus the 350, that's going to equal 610. So she now went from 0 cash flow to 610. 610. 0 to 610 in a minute by changing what she did with her money. She made one change, right? And that was what she was doing with her money and how she was paying for things. So now she has 610 as her cash flow. Okay, so that becomes her cash flow. So now we have to look at this and say, okay, so how do we calculate the interest then? How is the interest calculated? So we have to do this. Now, we know that our Capital One card there is at a 19% interest rate, okay? So in order to calculate our simple interest that is calculated on an average daily balance, we are going to what? Average it, right? So that's what we're going to do. So we take our 12,750, okay, so 12,750, we're going to add our low balance of 10,860, which equals 23,610, okay? And I'm going to divide that by 2, which equals 11,805. Now I'm going to multiply it by 0.19. Okay, so 0.19. So high plus the low, add it together, divide it by 2. Then we're going to multiply by 0.19, and that's what you get. And then we're going to divide that by 12, okay? And that gives us our 186. Now, I divided by 12 because what you got there after you multiplied by the 0.19 was a year's worth of interest. We don't want a year's worth of interest. We only want 1 month because we know that when we velocity bank, our simple interest is going to be lower every single month because we are putting more income in using this as cash flow now, right? We're using that 610, we're splitting it between 2 cards. We're using this cash flow to work this down. We are getting her out of debt when she has 0 cash flow to work with. 0. We're going to get her out of debt faster than what these cards are going to afford. And I will clear the board again for you and write out exactly what her savings is. Okay, but let's finish up. So we have our high plus our low, right? We get our interest here. We have our expenses. So when we add this all together, right, because our expenses are all being charged each month, right? We're charging those expenses now. We're dividing them between 2 cards. And so then we end with 12,586, right? Because this has to come back on the card. So does the interest. So 12,586. Now, when you guys are running your strategy, a check that you can do is, are your numbers increasing or decreasing? Are they going in the right direction or the wrong direction? Well, as you can see, if this is our starting balance here, we drop our balance by putting in our income, right? And then when you add the charges back out and the interest, is this higher than this? And yes, the answer is yes. So it checks out. Okay. So those are simple checks you guys do along the way to make it. It is, like I said, this is very simple. It's all simple math that we're working with here. And sometimes I struggle with that, which is hilarious. Okay. So 12,586 minus 1,890 again, right? We put our income in again. So now this is leading us into month 2, where we have dropped our balance now to 10,696. All right. But again, our expenses have to come out and our interest has to come out. And you can see our interest is lower. So that means that when we add all this back in, we are at 12,420. Now, again, 12,420 is less than 12,586. So again, we are going in the right direction. Now, what if along the way, some way along the way, let's say, she has a big expense that she has to afford? I don't know, new tires on her car, something like that. She's not dead in the water, okay? She might halt some of her gains, let's say, for the months going forward, right? So it might slow down the process and make it a little bit longer, but not by much. And life happens, you guys. She doesn't have any options for life right here. She doesn't. Her card will just continue to creep up and creep up and creep up if she doesn't have a way to work these down. So this is affording her the what if moments, okay? So that's what's so beautiful, again, about velocity banking. All right, so now we've made our check. We know this is good. We bring our income in, and month 3, it drops our balances to 10,530. All right. So as you can see, this goes on with this card here, Capital One. Now, same thing over here with our Discover card. Okay. So we have our high balance of 8,000. We have our income at 1,800, right? 1,800 is our income, which means we're at 6,200 for the low balance. Again, we take our high balance, we take our low balance, right? So if I write that out, we take our 8,000, right? We add it with our 6,200. All right, so. Okay, so that should be 1,420. All right, so if we take this, all right, so we've got 8,000 plus 6,200 equals 14,200. Okay, so now what am I going to do? So now I've got 14,200. I have to divide that by 2 now, right? So if I divide this by 2, okay, so we got to divide it by 2 is going to equal. All right, so I've got 14,200 divided by 2 is going to give me 7,100. Okay, so that's 7,100. And I keep closing this marker. Okay, so 7,100. So there's 7,100. Now, what do I do next? What do I do next? Next, I'm going to multiply it by, okay, I'm going to multiply it by that 27%. So I've got my 7,100 and I multiply it by 0.27, which equals 1917. And then I'm going to divide that then by 12, okay? Divide it by 12. So that gives us our 159, which is our first month of interest. So here you divide by 2, you take your 7,100, so you've got 7,100, and you're going to multiply it by 0.27, which equals, what was that? Let's see. I want to write it down so you guys can take a look at it here. It's 1917, right? So 1917, and then you take 1917 and you divide it by 12 to get the 159. Okay, and that equals 159. All right, so that is your interest that will be charged then on the Discover card each and every month. All right, so again, she's going to work it down the exact same way, 1540, and we've done an even split, as even as we can get it, right? And I'm just showing you. Now, could this be, 1550 and this be 1530? Yeah, that you could. Just depends on how your bills work out, right? And how you're going to split those charges out. So yeah, you could do that, all right? But for simplicity's sake, I'm just running it this way for you today. All right, so again, drops her balance to 7,899, or I should say it brings it back up to 78.99. Okay, and again, our checks. Here's our starting balance, right? Here is after all of our charges come back in. We're still below the 8,000, so we know that we're going in the right direction. All right, so how long does this take? Well, the first card here takes 42 months, and the second card then takes 40 months. So we're talking about 3.8 years to get these paid off. Now, when you're sitting in a situation where you have no cash flow, and she is looking for another job to hopefully gain her some more income, but even if she doesn't, for right now, this is going to work for her. And it might take 3.8 years, but you know what? It was going to take her a heck of a lot longer than that running it the traditional way. So I'm going to clear the rest of my board here and I'm going to show you exactly what she saved and over that traditional banking way. So give me just a second. So if we take a look over here, all right, I have traditionally banking has them spending or has her spending 8,000 at a 27% rate, and they would pay back, okay, $5,773 over 4 years and 5 months. Now, to do it, the Capital One card is going to be $12,750 to do it through the traditional banking way, and at 19%, it costs them $6,408. Okay, so when you add them together, that's going to cost them a total of $12,181. All right. But when you use the pay down strategy through Velocity Banking, all right, this is what happens, okay? And so these are the results of those numbers here. That's what this is. So we've got 8,000 at 27%, okay, remember? And when we Velocity Bank it, we spend then $3,969 versus your $5,773. All right, so now Capital One. At the 19%, we spent $5,149 as opposed to $6,408. So if we add these up, right? So if we take them and we take the 12,181 minus the 9,118, we have saved a total of $3,063. Okay, so $3,063 is what we've saved. Okay, we've also bought her time, right? Because this is 3.8 years, and we know that to get out of both of these, it's going to take 4.7 years. So we've shaved a year's worth of time off. And not only did we do that, we saved $3,063. Now, that money there could be any incidental that came up through the course of the months, right? So when you Velocity Bank, you find that you have options, right? So you have options because you've generated cash flow for yourself. Now, if she were to continue to traditionally bank like this, and then she has shiznit moments come up, she's going to be spending even more than in interest. Whereas here, she's spending less, right? And she's giving herself a cushion, right? To allow for the what ifs in life. I hope you guys have learned something today. I hope that I've made it more clear. If I haven't, please, by all means, put your comments in, send me an email, let me know. I'm trying to provide you guys as much clarity as possible. I think Dan did a great job the other day being really clear about, how you work down your strategy and where those numbers come from. So we're just expanding on that, making sure that you guys can go back to all of these videos and be able to understand exactly how these break down, okay? Also, you guys would love it if you like and subscribe. Have an amazing day, and we will see you next time.